Hello, everyone. Thank you so much for joining us today. My name is Marcia Butler. I'm the webinar director here at Advice Chaser. Before we introduce our guest and get started, I need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we're thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box. And let me go ahead and make sure that that feature is turned on for you. All right, just turn that on. If you ask a question in the chat box and we're not able to get to it, go ahead and leave your contact information, and we'll make sure someone reaches out to you after this event. Again, we want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'm going to introduce you to our speaker now. Jeff Costa is, let me get his bio up here. Jeffrey Costa is a portfolio manager and certified financial planner who crafts comprehensive financial plans and investment strategies for his clients. Jeff joined Schultz & Company in 2020. He specializes in holistic financial planning, as well as managing his clients' portfolios to meet their short-term and long-term goals. Prior to Schultz & Company, Jeffrey worked at First County Advisors as a trust and investment officer for 4 years. He began his career in financial services as a financial planner and investment advisor representative at Barnum Financial Group in the office of MetLife in 2009. He has taught on-site financial education in multiple Fortune 500 companies as part of MetLife's Plan Smart program. He also holds a BA in economics and political science from the University of Connecticut and has been a certified financial planner since 2017. And I'm very excited to have you back, Jeff, and I'm going to go ahead and turn over the time to you.
Great. Thanks, Marcia. I'm glad to be back with everybody here today. So today, as the webinar title implies, we will be discussing a lot of the kind of do's and don'ts for travel nurses and medical professionals, which in a lot of cases are really applicable to other professions because they're good foundational financial planning, things that you should be doing. But where they tend to be really important is because when you're moving around a lot and bouncing from place to place, your budget changes, your income changes, and a lot of the things that, people that are in maybe a career where they're not moving around as much only have to kind of readjust every few years or maybe every 20 years in some cases. This is something that happens all the time. So it's really important to be hyper vigilant about your spending, your goals monitoring, really just really kind of tightening things up on a regular basis so that you ultimately end up getting the full benefit for what you're trying to accomplish here, and taking these different assignments and trying to maximize your earning potential. So to kick things off, just like any other financial planning discussion, you really want to start with the end in mind, which is knowing your long-term goals. So for people who are considering or already doing travel nursing and things of that nature, you want to understand, like, why are we doing this? Is there a particular goal that you had in mind, or is it just you think you can make more money and all the extra money is it'll go someplace that we need it at some point, whether it's retirement or just for fun. So if you do have specific goals that you already have in mind, could be paying off a debt, saving for retirement, buying either a primary residence or rental property, or just going towards funding your career development. Those are all great things to know ahead of time, because then you can really start to put together a savings plan and start to allocate money towards those goals, and not just say, well, making more, so eventually I'll get there. This way, knowing I'm going to have an extra 20,000 or 50,000 a year that I didn't have before, now we should have a pretty decent idea of how long it'll take us to get to those goals and have a bit more of an actionable game plan. So starting off, let's talk about how you determine your income and what that ultimately, what are some of the ways to maximize your income as you potentially choose assignments and things like that. So as the slide here shows you, obviously you have base hourly pay, which is obviously straightforward. And then you can have additional stipends for meals, housing, work-related expenses. And the idea is to understand, first of all, how does it stack up to what you're doing currently? When you add all those different things together, is it a better deal than what you're doing right now? And then obviously we'll talk later about our expense side of the equation, which could certainly change that math as well. One thing that I will mention, after discussions with people who do this, because obviously I don't, because I'm a financial advisor, one of the tips that they always have shared to me is if you're working with an agency or two agencies, or oftentimes there's multiple postings for the same position at different agencies, is work them against each other, because they're taking their cut, and make sure that if ultimately you're the one who's benefiting the most, not the people who are the matchmaker. You're the one doing the work. So if you can get a better deal by potentially talking to a few of these same agencies for the same position, negotiate your hourly pay or your stipends or all those things, because all things may not always be equal depending on who you talk to. And so we want to maximize the income side, and then we'll also try to kind of optimize the expense side as we go through. But let's start with that. And obviously, as you go through, we want to make sure that you understand what the cost of living is when you move to different places. And we'll talk about that with the expense slides budgeting. So since Marche is already there, let's move on to don't spend without a plan. And pretty much all the financial planning classes I've ever taught, one of the key things that I always like to mention is it's not about what you earn, it's about what you keep. You can make all the money in the world, but if your expenses are higher than what your income is, it's still not helpful. So we want to make sure that we understand our budget, understand our savings goals, all those things, so that it's the net positive we're trying to maximize, not just the top line. It's what is your profit if you were a business, right? So income should always be higher than expenses. Let's move on. So along that line, basic living expenses, housing, food, clothing, how you're getting to work, and all those housing related and kind of, I'll call it baseline expenses. If you're moving to a new place, housing is probably going to change. Transportation may change depending on if you're driving to work and how long your commute is and all those things. But some of the big unknowns when you're going someplace new, or if you're bouncing around from job to job, could be healthcare. That's a huge one, depending on where you're getting your healthcare through and how that stacks up to what you're paying now. If you're getting it on your own because you're not offered it through either your assignment or through an agency or anything like that, you need to understand, healthcare is very expensive. all of you work in healthcare, you know it's expensive, but again, insurance can really vary greatly, and that could be the biggest pitfall when it comes down to understanding, you know, what you keep at the end of the, you know, the assignment, because you don't want to pay a ton more for healthcare and not expect it up front and work that into your income side of the equation. So let's move on. So let's establish our budget and our spending plan. The best way to understand your budget for the future is to look back at what you spent in the past. I always personally like to look at my year-end credit card statement because it provides a really nice summary. Some people have a checking account that they do the same kind of thing. Credit cards, I think, are really helpful. Obviously, you get points by doing it, but it also provides you a much more detailed budget summary. Some people also do, you know, different online either platforms or apps that help them organize. But you really need to understand what you're spending today so that you can understand how that might change depending on where you're going, you know, what type of position that you'll ultimately end up in, you know, again, with regards to transportation and healthcare situations. So start with where you are today and then adjust accordingly. And if you have anybody you know working in those particular locations, reach out. You know, your best resources are your peers in a lot of cases. And there's certainly no shortage of you know, different groups that you can reach out to, whether it's Facebook groups and other places where there's a good community and lively discussion. You know, that'll help you get a handle on things to at least start out. So obviously one of our largest expenses is housing, and we want to explore the different options that you might have available when you're going to a new location. Is it housing that's placed through the agency because they have a good deal with, you know, a certain you know, apartment complex or whoever it might be? Is it stipend pay, like you just find your own housing, which a lot of people ultimately decide to do because they have a lot more flexibility and they want to choose where they live, not be kind of stuck in a certain location. There are other considerations where maybe not right when you start a new assignment in a new place is, does it make sense to buy a property? If you think you might like the area or you think it's potentially a good up and coming area, you know, maybe it makes sense if you have the money to consider it as a, you know, a longer term rental opportunity, particularly if it's a marketable location and it's potentially a cheaper place than where you normally live. As far as real estate costs, it might make sense. So particularly for those people who are handy and enjoy that kind of thing, who may do some of the work on their free time, it could be a really good opportunity to diversify their wealth. You know, a lot of people love buying real estate. Some people less so. Some people like being landlords and others not so much. But it is something to consider, especially if you think you might stay in a given location for a fair amount of time, where it might be better to actually build some equity in a place and not have to pay rent. If you can qualify for the mortgage based on, you know, what your cash flow has been in the past, obviously just all the same rules apply to if you were to go get a mortgage in your current location. But it is important to think about that as a potential option. And then if you already own a property, you would need to understand if you would be able to carry two mortgages, as you know, obviously the bank or lender will need to run those numbers. But if you have a tenant in your old place, in your domicile state, you know, that rental income will go towards your income. So it could be a good option, something to think about. But just want to mention it for those people who might be inclined to maybe not necessarily just stay in a rental place. If you have the cash, could be a good opportunity. I had a friend who did that in Austin, Texas, and you know, he bought a few years back, and obviously that's a great place for real estate values in the last few years. So if you think you might see an opportunity, it's always worth considering. Moving along. So retirement savings. So depending on the structure of your compensation and how you are paid, whether you're a W-2 employee through the hospital directly, or if you're a 1099 contractor or through an agency, you may have the opportunity to do a 401k. You may need to consider doing your own IRA or Roth IRA if there's nothing offered through a group plan. The drawback to not being in a 401k is that ultimately the amount of money that you can save on a tax qualified basis is lower in an IRA than, say, a 401k to pretty big margin. If you're over 50, you can basically put $30,000 into a 401k, whereas if you're in an IRA, that number's closer to about 7. So it's really important to kind of understand what that structure might look like, because that also plays into the tax piece, which we'll talk about in a couple slides. If you're looking to do pre-tax savings, then your ability to do a 401k is really important based on that level. Because if you ultimately think you've been sheltering, whatever your maximum is, say it's 2022, and now you go down to 6 or 7, that's going to have a big impact on your taxable income at the end of the year. But the other key piece to talk about is, depending on how many different plans you have, if you've worked at different assignments over a period of time, where you've been at multiple employers as a W-2 employee, it might be a good opportunity to think about doing a rollover and simplify your plans. We actually just recently did a webinar all about rollovers, just as a whole topic. But net, it's a good opportunity to consolidate plans, perhaps have better oversight on your investment options, potentially could reduce fees internally on those various plans, but something to consider as you evaluate your retirement options is to kind of look at perhaps your old plans. All right, let's move along. So one of the first things we mentioned today was our goals. If one of your goals is to pay off debt because you're perhaps earning more in an assignment in a different place, is how do we figure out a good debt pay down strategy? Now, there are some different options that people typically have utilized in the past. Some have, I think, a better foundation in math. Others just make people feel better or feel like they have a good way to organize. But two of the most common methods that you'll see if you kind of read up on some of these different strategies, you'll see the debt snowball and the debt avalanche, if you will. So debt snowball is saying, okay, I have 5 different credit card debts as an example. I'm going to start with paying off my smallest one first, regardless of the interest rate. So I pay the minimum payment on all the cards except for one, and essentially whatever's left over for what I usually use for debt repayment would now be allocated towards paying off that smallest balance. Once that's paid down, then we move to the next smallest balance, and so on until all the debt has been retired. The other option is what's referred to as a debt avalanche. So the debt avalanche, which is what I personally would recommend, is paying off the highest interest rate balance first, for fairly obvious reasons, because you're paying the most amount of money extra than you need to. So if you can knock that out first, you start allocating all that extra money that would have ultimately gone towards kind of call it shotgun approach through all your different cards. Now you just pay the minimum on everything except the highest interest rate, and then go down the line until you've got all those paid down. And once you started knocking down all those debts, you can use any extra cash flow that you ultimately had been putting towards debt, you can reallocate into your savings goals. And so whether that's bumping up 401k allocations, whether that's doing an IRA on the side, or in some cases just in a normal savings account where it's a lot more flexible, whatever you ultimately decide to do, it can be obviously a much better use of funds than paying down unnecessary interest. Okay, let's move on. This is a much more fun slide. This is treating yourself. So anytime you're working crazy hours and perhaps many days on end, there's a high propensity for burnout, and it's really important to take care of yourself because you're your most important asset. And plus, everybody's entitled to some fun. And what you want to be able to do is ahead of time when you're working on your budget is to build this in as a line item, because it really is a necessary thing to plan for and thing for our mental health that certainly is beneficial over time. So we can put it in between assignments. You say, okay, well, I'm going to have X amount of money left over based on my budgeting plan. So this is the trip I plan on taking, and this is my budget for it. Or you could just kind of build up a general fund and say, okay, at some point this year, I'm going to take a $10,000, $20,000 trip to wherever I want to go, and so that can be a really nice option. The other third option is really if you ended up taking an assignment in a tropical place to begin with, then you can maybe just take it without having to buy a plane ticket and take some time off in between assignments. That's the financial planning, best case scenario. All right, moving along. Everybody's favorite tax situation here. Hopefully everybody remembered to file taxes yesterday. So let's understand the tax implications of our income now that it may be different than what we're currently doing. So base hourly pay is always taxed just as ordinary income. So no change there, but where you have an opportunity to perhaps have a lower tax burden is if you get a stipend that's particularly earmarked for meals, housing, and work-related expenses. Those are kind of, call it reimbursement type money, where you don't get taxed for it because it's ultimately allocated as an item that is tax preferenced. But in order for stipends to be non-taxed, you need to make sure that you show that you have a tax home that's not where you are currently, and you need to be very detailed about keeping receipts for those expenditures. Also, in any different state that you work in, you need to file a tax return in that state, as well as your permanent tax home. That doesn't mean that you pay tax to every different state, that you don't pay income tax. If you worked in 3 different places and you pay income tax in 3 different places, triple time, you just get a credit for whatever you pay to different states. That's certainly a very common situation, and obviously you want to understand up front what that might look like, depending on if the state that you're working in has a much higher tax rate than your home state. Then obviously that takes a bite out of what you keep. So that should be part of your evaluation of whether the assignment and the ultimately the income that you're being paid for is worthwhile. But again, that's something to really pay attention to. All right, so if you decide you want to keep your current tax home and make sure that your state government or the government that you are, of the state that you're working in throughout the year knows, which is your domicile, then you need to do a few things to maintain your tax home in your current state. So really important to have things like driver's licenses, voter registration, car registrations. If it's possible, if you keep a per diem position in your current home state, then that certainly helps prove that you are still tied to that state in some sense. And then returning home to your home state at least once every 13 months, just to kind of prove that you still do have attachment there. A lot of times people will have a primary residence in that state, but again, actually residing there is more important, periodically than just owning a property there, because anybody can have a parental property anywhere. That doesn't mean that's your domicile. And then, as we mentioned before, we would make sure that we file a resident tax return in your home state. Okay. So there's obviously a lot of different nuance to kind of moving from different assignment, moving to different locations, and you've got the retirement piece, the tax piece, the budget piece. So why should we work with an advisor to maybe help on this journey? Well, it helps us clarify our goals. Really, if you have somebody who can help model some of these things out for you ahead of time, maybe in a more nuanced fashion than you could in just an Excel spreadsheet, that can be very helpful. Again, understanding what our tax burden might be in advance, understanding what our retirement savings opportunities could be, and then just having accountability. Somebody to whether it's on a quarterly basis or a semi-annual basis, say, well, our budget was supposed to be this, and this is how we're really tracking. Having that accountability with anything is always clutch to staying on track. And then last of all, many advisors also have good relationships with other professionals like CPAs and attorneys who can help out with a lot of the different issues that may not be exactly the same as what your financial advisor is helping you with, but certainly related. So having a good team of resources around you is really key. And just again, when we talked about the tax piece, I didn't mention, but a lot of people are do-it-yourselfers as far as tax filing, which is fine. I'm a do-it-myselfer, but particularly in the first year or so that you are doing something like this, it certainly may pay to hire someone to help make sure that you don't miss anything or leave money on the table. And so I would encourage, to perhaps engage a professional if you're not sure, or you just, quite frankly, you may just not have the time. Because if you have to file a couple more returns, then that's time away from all the other things you'd rather be doing. And so just a little side note there. But that's pretty much all the content that we had for today that we wanted to make sure we went over. So I guess we would open it up for questions. And again, if it's something that we can't answer today for a variety of reasons, we're happy to get back to you, afterwards with any answers.
All right, so I do have a couple questions that I've gotten in here, and then I want to encourage people, if they have questions they want to type in the chat, they're welcome to do that. This is a good question. Do you need a larger than average emergency fund if you're a travel nurse or a travel medical professional?
I would encourage you to probably have a larger than average, because your unexpecteds are higher than normal, right? I mean, you don't know what you don't know. And so I would say anytime you're in a new endeavor, whether it's travel nursing or starting a business or anything that is new and different than what you're currently doing, then it always makes sense to have a little extra buffer. And so while not necessarily something that I would say don't take the job if it's really good, a good opportunity, it is something to say, okay, well, in the past, I've always kind of kept a 3-month buffer or something, or maybe now we do a 4 to 6 month buffer, and build it up as you go. It could be a target. It doesn't necessarily mean that you have to have that on day one, but again, anytime there's more unknowns, and if you're not sure what your budget might look like, that could be something that would make sense. I mean, it's never better to have more cash than less on hand in pretty much all situations. But do I think you need to have a year or two's worth of emergency? Probably not. That's a little excessive. But it's certainly, depending on where you are today, I would say at least have a 3 to 6 month buffer, just because if you take time in between assignments or something like that, where you may have a little bit of gap in income too, just to smooth you out.
All right, here's another question. Do you have any tips for staying financially organized, especially with the idea that taxes are going to be more complicated?
Really, I would say you just need to be a little bit more detailed with your budgeting, and try to do some research up front. Like I said, understanding what the cost of living might look like. Talk to people who, if you know anybody that has worked in the particular areas where you're looking to go. That's always good. But again, one of the things I mentioned before is if you do have an advisor, that certainly can help you stay organized and stay on track, and build maybe a more realistic plan than maybe you were thinking. Advisors work with people every day and maybe see things that you hadn't thought of to plan for. Because again, like anything, you don't know what you don't know. And so it's one of those where you just want to be maybe over prepared and pleasantly surprised and have extra money, rather than the opposite. But anytime you're doing something new, it's always good to kind of maybe take a little extra time to plan and maybe have a little extra cash.
Do you have advice on hitting either a higher or a lower tax bracket depending on how much you're making? Can you talk a little bit about strategies around tax brackets?
Well, so if you think you're going to be in a higher tax bracket, then it makes sense to perhaps increase the amount that you're allocating towards, say, a 401k or an IRA, depending on what you're doing. If you think you would ultimately be in perhaps a lower tax bracket than you were in the past, for whatever reason, I'm not sure likely how that would come into play, because the goal is to make more money generally. But if you did find yourself in that position where for a period of time you were in a lower bracket, you may want to lean into maybe a Roth IRA, a little bit more a Roth 401k, because you want to fill those buckets in years where your marginal tax rate, so the last dollar that you earn, is taxed at the lowest rate, because it's all after-tax money. So you're not getting a tax deduction on that. So depending on where you are and where you expect to be over a period of time, that would ultimately determine maybe which bucket you ultimately decide to allocate more or less to over that time frame. I always like to have people allocate towards a variety of accounts and never an all or one strategy, because you don't know where tax rates are going to go, where incomes are going to go. So you want to hedge your bets, but you may lean into one side of that or the other in a given year.
Yeah, there's just a clarification on that, saying that like the hourly base rate will be lower than what they're currently making, and the stipend is tax-free. So that's why they're looking at a lower tax bracket.
Yeah, that makes sense. So I would say in those years, if you have the opportunity to either through an employer plan or just on your own, if you qualify, which if you're in a lower bracket, there's a good chance you'll qualify for the Roth IRA limits, is to look at doing those after-tax savings accounts that are basically tax-free for the rest of your life. Roth is one of the most amazing types of accounts if you can get money into it, and particularly if you can get into it at a lower tax rate, because you're taxed on the way in and then you're never taxed again. And there's no RMDs either. So you're never forced to take it in the future, at least in current rules. So that's something that I would say, if you're in a lower rate and you maybe in the past had always done traditional IRA or 401k, then this could be your opportunity to bulk up in that Roth bucket.
And then we had another question about that. What about Roth conversions on a lower tax year? Can you talk about that?
That could be a great option as well. Again, that'll ultimately bump up your bracket because every dollar you convert gets added to your income. But that's certainly a good opportunity to do that. And depending on what your ultimate time frame is for how long you plan on being in this situation where you are in a lower bracket, you don't necessarily have to do it all in 1 year. You can spread it out over, if you plan on doing this for a few years, you can systematically do that over a period of time. But Roth conversions are certainly a good opportunity if you already have a bunch of money in traditional and that's the way you want to do it.
All right, here's an interesting question. I'm looking for automation tools to help me with savings towards my goals. Is there any particular method you recommend to automate it so I don't think about it?
Well, usually you can set up a monthly transfer to different institutions if you're going to ultimately set up say a brokerage account or an IRA account or whatever it might be, similar to how you have money taken out of your paycheck for a 401k or 403b or whatever it might be, where you could just automatically set up an ACH from your checking account to pay yourself first, which is really important. So that takes the thought out of it, just automatically goes. But that's really something that can either be accomplished online with just linking your checking and telling them how much to pull each month, or with like an old-fashioned form, depending on what type of an account. But that's very easy to set up if you're just looking to allocate money to a particular account.
All right. Well, I think that's all the questions that we have in the queue right now. If I had missed yours, I'm sorry. We'll look through that again and make sure we didn't miss any of those. I want to thank all of you for being here, and I want to thank Jeff for his expertise today and for the organizations that have made this webinar possible. To our attendees, look to your email soon with a link to the replay of this event, and you're welcome to share that replay with your friends and family and fellow travel professionals. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners is committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Goodbye, everyone.
Thank you, Marcia. Take care.
Thanks. Bye-bye.